Ladies and gentlemen, the world of cryptocurrency has recently been set abuzz with an exhilarating forecast. Investment giant Pantera Capital has given a striking prediction. Bitcoin is poised to surge to a colossal $150,000 in its upcoming 4-year halving cycle, all detailed in their recent blockchain letter released the 22nd of August. Before we begin, however, I would like to remind everyone that this video is intended for entertainment and educational purposes only. I am not a licensed financial advisor, and investing in cryptocurrency always carries risk. With that aside, let's get into it. For those that perhaps are unfamiliar with the intriguing world of Bitcoin's economics, let's dive into the essence of it. Bitcoin operates in sheer contrast to the quantitative easing or the printing of money used by countries worldwide. The genius yet enigmatic creator, Satoshi Nakamoto, designed Bitcoin's DNA to ensure only 21 million coins ever exist. And the intrigue does not end there. For now, every 10 minutes, 6.25 Bitcoins are bestowed upon the world. But here's the clincher. Every 4 years, this figure is slashed by half in a process captivatingly named the halving. Estimated by the year 2140, this mathematical dance accumulates with the release of the 21 millionth Bitcoin. Mark your calendars. The financial world is poised with bated breath for the next halving, predicted to be on April the 20th, 2024, when the mining reward will gracefully diminish from 6.25 Bitcoin, what it is currently, to 3.125 Bitcoin per block. If we travel back to 2009, pioneers in the cryptocurrency space would mint a handsome 50 Bitcoins for each block mined. Fast forward to April 2023, and a staggering 19.3 million Bitcoins are circulating, leaving a tantalizing 1.6 million still up for grabs. Let's rewind again though and explore the historical halvings and what's happened previously when this happens. On November the 28th, 2012, a notable day when the block rewards was slashed from the initial 50 to 25 Bitcoins. July the 9th, 2016, the virtual gold rush slowed as rewards dwindled to 12.5 Bitcoins. And the most recent halving, May the 11th, 2020, brought the bounty down to just 6.25 Bitcoins like it is at the moment. While Bitcoin's blueprint targets a 10-minute window for the discovery of each block, mathematical probability does have other plans. Some blocks stubbornly resist discovery, taking longer than the target, while others succumb quickly. This variability can shuffle the timeline for halving events. A case in point. If block discovery averages 9.66 minutes instead of 10, the 210,000 blocks required for a halving would be unearthed in 1,409 days, shaving off 52 days from the theoretical 4-year mark. While conventional wisdom might suggest market knowledge of such a deterministic event would neutralize any price advantage, history, along with the venerable Warren Buffett, beg to differ. The iconic investor once said, "Investing in a market where people believe in efficiency is like playing bridge with someone who has been told it doesn't do any good to look at the cards." Economically speaking, if the hunger for new Bitcoins remains unwavering as it currently is, yet their supply dwindles, the laws of supply and demand dictate an uptick in prices. Past data suggests a fervor for Bitcoins as we approach a halving, heightening the anticipation of this price swell. Historically, Bitcoin has taken a curious trend, dipping approximately 477 days before halving, surging in its run-up, and then skyrocketing post-halving with rallies averaging a thrilling 480 days. Contrary to popular but perhaps debatable understanding, Bitcoin is neither inflationary or deflationary. To an extent, it could even be argued that it is inflationary, but with a cap on the total supply coming into action in approximately 115 years. At their core, these two economic practices, often referred to as tokenomics in the crypto realm, are distinguished by their contrasting supply dynamics and monetary mechanisms. Deflationary cryptocurrencies like BNB, Stellar, Matic, Tezos, and many more are characterized by a capped coin supply. These are akin to precious metals like gold in their scarcity. Over time, as demand rises and supply remains fixed, the purchasing power of these tokens generally increases. Such coins and tokens are often seen as digital savings accounts, safeguarding value against inflation and promoting long-term holding rather than immediate spending. Inflationary cryptocurrencies like Dogecoin, Link, Hedera, to name just a few, are on the other side of the spectrum, however. These lack a fixed supply cap. As more tokens are minted, their purchasing power can decrease. However, this is not necessarily a drawback. By continuously introducing new coins, inflationary cryptocurrencies can fuel liquidity, encourage spending, and also stimulate rapid adoption. They can also be tailored to an ecosystem's needs, adjusting the inflation rate to fund new projects, reward participation, or counter external inflationary pressures. But what does this mean for users and investors? Inflationary models align more with traditional fiat currencies. They're geared towards an ongoing utility and also circulation rather than long-term hoarding. Their malleability allows them to adapt to market demands, potentially providing a more stable economic model. Deflationary tokens, with their inherent scarcity, are often seen as digital gold. They attract those looking for a hedge against traditional economic downturns, inflationary policies, or just a place to park assets that may appreciate over time. Cryptocurrencies can also change their tokenomics during their lifespan, and also, rather interestingly, be inflationary and deflationary concurrently or at the same time. For example, Ether has no predefined supply cap, leaving some to perhaps cry inflation, yet a closer look paints a more nuanced picture. With its adaptive protocol, Ethereum has mechanisms that both inflate and deflate its native currency's value. Initially, Ether's issuance rate stood at roughly 5% annually. However, several facets suggest a shift towards deflation. The blockchain world buzzed as Ethereum migrated from energy-intensive proof of work to proof of stake. This seismic shift reduced the issuance of new Ethereum, pivoting it towards a deflationary trajectory. With proof of stake, validators need to stake their Ethereum. As more of this cryptocurrency is staked, less of it circulates in the market, potentially boosting its value. This is on top of Ether being burnt when used as transaction fees as well. Ethereum isn't just a currency either. It's a platform that hosts thousands, if not millions, of multi-functional smart contracts. As more developers craft decentralized apps, or dApps, on its framework, the demand for Ether increases. Factor in Ethereum's pivotal role in the growing DeFi sector, and you've got a recipe for increased Ether demand and also potential price escalation. Ethereum showcases elements of both inflation and deflation, like the yin and yang. These aspects coexist, making Ethereum a dynamic force in the crypto cosmos. As the blockchain evolves and the landscape shifts, only time will tell which force gains the upper hand. For now, though, keep your eyes on Ethereum. It's a crypto story that is far, far from over. Moving back to Bitcoin, though. To put things in perspective, if Bitcoin stays true to its past, it would have touched its lowest ebb on December 30th, 2022. Interestingly, this new low was witnessed slightly earlier on November the 9th, 2022, amidst the ripples of the FTX fiasco. This, however, is only around 51 days or a 10% variance. Predictions place Bitcoin at a promising 35,500 come halving day, with some experts predicting present performance to eclipse this figure by 7%. Delving deeper into the analytics, the stock-to-flow ratio offers riveting insights. Simply put, this model studies the change in Bitcoin's available supply, or stock, relative to its production rate, or flow. Past halvings have seen supply reductions with differing impacts on price, and if the winds of history blow consistently, we might see Bitcoin ascend to 35,000 pre-halving and only to soar to an astounding $148,000 thereafter. So to all our crypto enthusiasts and curious spectators alike, strap in. The Bitcoin roller coaster promises more and more thrills than ever. Stay tuned, like and subscribe for more updates from the heart of the crypto universe. BSC News. Speak soon.